Good afternoon, everyone. When I was working on the trading floor, ethics was one of these words, just like transparency or disclosure, that made my compliance officers happy, but that didn't mean much in practice. Why? It was not only the cynical view that you can't force people to be more ethical and therefore it's irrelevant. It was also that since ethics was not linked to how my performance was measured or my bonus calculated, why should I care? Now that I have left investment banking, I still believe that people's ordinary schizophrenia, that is, their ability to be very caring with their close circle of friends and family, while sometimes being careless to others, will always lead to improper behavior from time to time. I am convinced, however, that people respond to incentives and that we can create an environment more conducive to appropriate behaviors. So when talking about ethics in the financial sector, what are we talking about? What are we trying to achieve? Ethics asks the question, what actions are right or wrong in particular circumstances? Essentially, it asks the question of what actions and behavior should be fostered and which should not be encouraged. And this is particularly important in the case of financial services, so even though the behavior of financial service professional is arguably no less ethical than in other sectors, the detrimental impact of bad behavior is larger in finance, given its central role in our economy and the cost of crisis for citizens. Now, while it is still work in progress, tremendous work has already been done in this area to identify the appropriate behaviors and what we are aiming at. There is, for example, a fairly wide consensus around the idea that we should encourage actions and behaviors that lead to finance serving the real economy and the widest range of stakeholders in a sustainable manner, rather than those where finance serves itself and has a detrimental impact on the wider economy and society. And practically, this objective can include several intermediary goals, such as a financial sector that is robust and stable, that is able to provide essential services such as customer deposits, payment systems, and loans to businesses and households without risking major disruptions with spillover effects on other sectors. This implies, for example, structuring our financial system so that financial entities are not too interconnected and do not all fail at the same time, so that they can be allowed to fail without triggering a domino effect or needing to be rescued. Another goal could be a financial system that does not generate negative externalities or moral hazard. Negative externalities are an implicit subsidy from the rest of the economy to the financial sector and should be curbed as much as we can. And the impact of failure and bankruptcies in the financial sector should be borne by the financial sector, not by external stakeholders. We should also promote a financial sector that is able and willing to provide stable long-term lending to the economy, not one that overheats, lends ever more in good times, creating asset price bubbles in the process, and then turns off the tap suddenly in times of stress. And this is an important point because while there are many discussions these days about increasing the supply of credit to the real economy, the qualitative element seems to be missing from the debate. There is indeed never any lack of credit supply in good times. The issue is when the funding channels dry up very quickly during crises. And therefore, what is needed is not so much more funding in general, but more stable funding that does not disappear quickly in times of stress. I also mentioned willing earlier, and there have been many examples of financial entities able to lend but not willing to, as they choose to allocate their capital to more productive activities. This could and should be addressed, but has yet to be done. And similarly, some key sectors might be underinvested as they are not perceived as attractive enough from a short-term return perspective, whereas they're crucial for society as a whole and in a longer-term perspective. such as financing the shift to a green economy. Another goal could be a financial sector that benefits the widest range of stakeholders as opposed to serving a minority. Searching for profitability is a legitimate objective as long as it does not involve predatory behavior where asymmetry of knowledge and information is used to prey on the weaker stakeholders. And we have seen numerous examples over the past decades, from toxic structured loans sold to municipalities to overly complex credit derivatives sold to uninformed investors. Well, arguably, the financial sector, just like any other private sector, is making decisions that maximize value creation for its stockholders. And yet, the creation of public safety nets a century ago and the more recent bank bailouts have implicitly recognized that some financial services are deemed essential for the functioning of our economy, and therefore being subject to regulation that aims to align interest with the wider stakeholders is only a fair price to pay to enjoy this enormous benefit. In this respect, the recent political focus on competitiveness is a cause for concern. While competitiveness is a legitimate objective, we should be careful not to go back to a short-sighted focus on competitiveness at all costs, including at the cost of financial stability, at a time where we haven't finished paying for the last crisis. So my purpose here was not to provide an exhaustive list nor to close the debate, but rather to highlight the fact that while this is still work in progress, a lot of work has already been done, and there is a wide consensus around some objectives and behaviors that we need to promote. Now, how do we translate these objectives into change? How do we get there? What incentives are necessary? Well, here too, I would argue that tremendous work has been done before and after the crisis to identify the best incentives and rules to foster the most suitable behaviors and models. And the good news is, while financial markets may evolve quickly, detrimental behaviors and major risk factors do not. As an example, the near collapse and bailout of long-term capital management, the biggest hedge fund of the world in 1998, was already a lesson about excessive leverage and interconnectedness through derivatives, the same factors that were present in the 2007-2008 crisis. So we know pretty well which banks' business models are more robust and more focused on lending to the real economy and which ones are not. We also have a fairly good understanding of which compensation structures align interests with clients and which ones create conflicts of interest. We know as well which financial channels are more stable, less prone to overheating, and less likely to create domino effects. We have learned as well that tools such as financial education, transparency, and disclosure, while useful, are not sufficient and need to be complemented by binding regulation in some areas. So some of these incentives have been translated into law and implemented, such as clawback clauses and bonuses or increasing bank regulatory capital, etc. But many more have yet to be translated and implemented, such as a meaningful bank structure reform aimed at reducing risk for taxpayers. As importantly, recent regulatory initiatives that put competitiveness before all of the previously mentioned objectives might put us further away from achieving these objectives. Which brings me to my last point. Could it be that the weak link in achieving change is not so much knowing where to go or what to do, but rather a lack of political will to reform? A number of objectives have already reached a wide consensus, such as financial stability, accountability, inclusiveness, addressing conflicts of interest, etc. And a number of tools have been identified to achieve these objectives. So what is missing to translate this into law and implement them? Or put differently, what explains that 8 years after the most severe crisis for the past 80 years, and after 5 years of financial reform and thousands of pages of legislation, we have not managed to comprehensively integrate the lesson from the crisis, whereas the political momentum for financial reform is closing, and we are going back to almost business as usual and to the failed mantra of deregulation for growth. So the question is, how do we reopen the political momentum for reform? And more generally, how do we ensure that a limited amount of political will can translate into doing the necessary reforms without waiting for the next crisis? Well, arguably, policymakers have to juggle with many objectives that sometimes can conflict, from financial stability to job creation, competitiveness, etc. And yet, I strongly believe that taking the long-term view over the short-term one already removes a large number of these perceived conflicts. As an example, while financial stability might conflict with a search for additional short-term profitability, it does not conflict with sustainable value creation. And I also believe that in case of doubt or conflict, the guiding and overarching goal should always be the public interest, understood as measures that benefit the most over measures that benefit a minority. Understandably, the current economic context of low growth, low interest rates, and fears of deflation puts policymakers under additional pressure to focus on short-term solutions over long-term ones. And also, other factors sometimes compound these issues, such as the short-term mandates of politicians, intellectual capture and belief in failed dogmas such as austerity policies, lack of resources, allowance for revolving doors, exposure to highly imbalanced lobbying, or the fact that elected officials are not legally bound by their electoral promises. All of these factors and some others might incentivize policymakers to take an excessively short-term view. They might also, in some cases, misalign their personal interest and public interest and weaken the political will to put the necessary reforms in place. To be clear, I do not claim to have the answers to these issues. But the question I want to leave you with today is this one. When we talk about ethics, behaviors, and incentives, shouldn't we take a broader view and not only focus on incentives for the financial sector, but also on incentives for policymakers to take the long-term and inclusive view if we want to be able to achieve change? Thank you very much.